Hey everybody, this is Jose Blasco. This is a sound check to confirm that sound is good before we start the session in 30 seconds. Please go ahead and type in the chat box if that's okay. A quick hello would do anything to confirm that you hear me, and that way, I would understand that we're ready to go. Ten seconds to go, guys. Very nice, perfect. That's it. We just reached the top of the hour. We are live. Let me turn on the video stream as well, so I can say hello from my bottom right corner of the screen. How are you, everybody? A pleasure to be guiding the session today. Today is actually August 27, 2020. We are hitting the latest part of August, isn't it? The month is almost over. So let's begin our session today looking at longer term opportunities. And normally what we do is we look at options, we look at directional trades, we look at non-directional trades, and we start positioning ourselves in this way. How are you, Fermon? Good to see you, Fermon. Pleasure to have you. Before we start, as always, I need to give you the opportunity to read the disclaimer. So I'm just going to highlight it, and please read it carefully. This is important information. So this session is for educational purposes only, as you know. And, so read all of this carefully yourself. Obviously, we're going to be executing trades. I will be planning those trades out of following rules. For sure, if you take the trade, it means you're okay with that, as well as the fact that you use either paper money, real money, smaller size, larger size. All of those are your decisions, as it is obvious, and I count on you to be religiously disciplined and to be professional. And if you are lacking knowledge on what we are doing, make sure you prepare yourself, you educate yourself, seek for help. We can help you ourselves, but make sure that when you click the button, you know what you're doing, okay? Cool. With all of this said, again, here is a chart of the S&P 500. Started making all-time high again. This is unbelievable, isn't it? Especially in the world in which we are. Certainly, since a long time ago, the markets and the reality of the world and the economies is two different animals. The world is in very big pains, and the market is making all-time high. Where is the common sense there? So many people are still surprised by that nowadays, where it's obvious, especially since markets became electronic in the 90s, which is decades and decades ago. It's obvious that everything changed from being, let's call it, reasonable. The markets may behave crazy, but reasonable all the times, where now the markets and the world is two different animals that do their thing independently. Okay, so we need to, more than ever, be very, very focused on the execution of the trades, based on the plan, based on the rules, because if you allow yourself to be biased based on your beliefs or whatever news you heard somewhere on TV or some article you read, next thing you know, you may get in trouble, because again, the markets are going to do what they have to do. Okay, so our job is to rely on probabilities instead of relying on beliefs or biases or things that are not quantifiable. Okay, and this is exactly what I'm going to do today as we go through planning the trades. Okay. How are you, Maranu? Good to see you. Very nice that you're joining us today as well. Very nice. RH, how are you? Good to see you as well. Very nice. So let's begin. Okay. First, got a couple of trades to be reviewed. Only two this week. Okay. Nike, which is a trade obviously that has been moving against us for a long time. So let me show you Option Station Pro. Okay, again, remember, this is longer term trading. Okay, so this is not intraday trading. So we are not taking one trade at a time. In this case, we are building portfolios and running multiple trades in parallel. We are meeting 45 minutes a month. Okay, so obviously 45 minutes a month is not enough to build a portfolio made of multiple positions. Okay, so what I have in the portfolio right now is one trade with Nike. Okay, because the other one I have to show you was completed last Friday, and actually it was a profitable trade, but it was fully completed. Okay, so basically I'm left with only one trade on the portfolio, which happens to be a losing trade, which is okay. But remember, what I want you to envision, okay, so you understand my intention during the session today, is envision multiple positions where some are long, some are short, some are directional, some are non-directional, and basically they kind of offset each other. When one is wrong, the other ones profit. Okay, and because we are dealing with gamma, the ones that profit at an accelerated rate, where the ones that lose at a decelerated rate, and therefore uh, cases we've seen many times, cases like Nike, okay, where we got short that day at that time expecting Nike to fall. We were deadly wrong on this trade where Nike went all the way in the opposite direction. Guess what? Now the market is about to tease, okay? Typically, when the market makes all-time high, it gives you a tease, and then there is a mini crash coming in. So if there is a mini crash coming in, guess what? Nike may go back into the profit territory while we made profits on the way up with other positions that we closed in prior weeks. Okay, and again, in the account I use here for the sessions, as I said, I only have Nike running, but if you were to envision those multiple trades running in parallel, you would understand the concept, right? Anyway, so Nike is what we have. OTA, that's a trade that was concluded last Friday. So we got into the trade on the 14th of August. This was a non-directional trade. That was an iron condor utilizing August 21st expiration day. That was last Friday. And I remember reviewing this trade with you last Thursday. I believe that the price of that stock was somewhere in here. So, we were basically pointing at that vertical line like it's almost a sure thing it's going to be a profitable trade, but we didn't know for sure until the Friday, right? And so I'm showing to you today this trade, which is now completed, okay? And therefore, I'm going to remove this trade from the to be reviewed list of symbols. We don't need to review it because the trade is over, and this one was a profitable trade, okay? Good. So with all of this in mind, let's now begin our session looking at the scanner, and we're going to start with non-directional trades. Let me take a look at the chat box as well. Carlia, how are you as well? Yeah, very nice, very nice. A few of you from Indonesia, isn't it? Very nice to have you join us in the room, guys. Cool. So let's begin. Okay, so non-directional trades. So the first thing I'm going to do is I'm going to sort the symbols from higher price to lower price. I'm going to start looking at Baidu. The reason why I'm going to do this is because non-directional trades means selling options. And for sure, we know options derive their value based on multiple factors, but one of the key factors is the price of the underlying. So in other words, the higher the price of the stock, typically the higher the value for the options, okay? Not always exactly like that because of how options are priced, which is a complex matter, okay? But in a simplistic way, the higher the price of the stock, the higher the price of the option. And therefore, I want to start with high price points because I'm going to sell options. And when you sell options, the most you will make is what you collected when you sold them. So I want to sell them for as much as possible. And because the higher the price of the stock, the higher the price of the option. So I want to start with the stocks with the higher price value. Okay, so I'm going to start with Baidu, even though my first impression is disappointing because we got a UFO performance stats of 47.17%. If you have been attending prior sessions, you know the minimum we require for a non-directional trade is 48%. So that stock does not qualify, but I'm going to give it another chance by looking at pre and post market data. And now it's even worse, pointing at 42.51%. So in other words, that stock does not qualify as a valid candidate for a trade. Okay. So next one in the list is IEF. That's an ETF, so I'll just skip it, and I will then move into FISV. And as I do this, I would also like to bring in TradingView to the screen because we're going to have to be looking at earning dates, isn't it? So I have a workspace here, which is convenient for that purpose, where I'm going to type FISV, okay, and TradingView is going to tell me that, hey, the past earnings took place on August 5. This is already passed. The next earnings will take place in November 3. So in other words, I could use options for a potential iron condor that expire all the way into November, okay? In other words, that's a great news. Now, with pre and post market data, that stock is giving us 45%. That is not good. If we move to regular session, so that stock is giving us 54%, and that is a very good news, okay? And now we are happier, okay? So since that is a better news, so let's begin planning a trade with FISV, and let's see if we're going to find a way to make this trade work, or we won't. Okay, so of course we can use expiration dates all the way until November 3, meaning that we can use Friday 28. Probably is going to be too short, isn't it? We can use September 4, we can use September 11, we can use September 18, September 25. So again, I'm going to shoot for September 4, which is 8 days from now, and see what happens from there. So I'm going to pick any strike, right click, analyze and sell, an iron condor. Okay, notice it doesn't matter where you click, because what I'm going to do is I'm going to run some analytics first, and then I will select the strike. So I'm just doing this to have TradeStation bring me to the analysis tab, which is what happens when you do what I just did. Okay, so now I have an iron condor there with random strikes, okay, which they don't matter at the moment. We have a specific expiration date. This does matter very much, because with that expiration date and the fact I have selected one standard deviation plus, one standard deviation minus, so now I know that from now until September 4, a normal thing to happen based on probabilities would be that the stock remains ranging anywhere between 93.8 to 103.4. Okay, 103.5. Okay, so that would be a normal thing. So with those values in mind, I am going to go back to the chart and plot 93.7, which is more or less here. Okay, and I'm going to plot as well. We said it was 93.7 and 103.57. So 103.57 is somewhere here. Somewhere here. Okay, so now price is here in the middle. Okay, price is here in the middle. So we are equal distance from those dotted lines. That's good to know. And dotted lines are good to know because they're a good reference. This is price based on probability should remain between those dotted lines from now until September 4. So all of this is good to know. But at the same time, it's not enough probability for us to do a trade. We need to rely on something solid. And something solid, of course, are going to be our friends, the UFOs. Okay, so I need to find out where my next UFOs are. Okay, and notice that if I zoom out, okay, I got a UFO located here at 186 something, sorry, at 86 something, and then I got UFOs above. Okay, now one of the rules that we use to be able to do these trades is that we need to make sure that we have at least two UFOs to defend ourselves. So in other words, if I was to set that particular UFO as my upper limit for the range, that would be great, because that upper limit happens to be beyond the dotted line, which represents where the price should stay, right? So going beyond the dotted line is less probable. And if it was to try to go beyond, I got UFOs to bring the price down. And not only I have one, I have three. So that's a great protection for the price to not to go too high, and therefore increase the probability of staying in the range. The problem is that if I look at the UFOs below, I only have one. And we have a rule, which is we need at least two. Okay, so that forces me, that pushes me to bring my bottom UFO to be minimum 85. Okay, and that obviously creates a very imbalanced situation, where if you calculate the distance from current price to the upper dotted line, that distance, let me do that again. Here we go, I got it now. So that distance will be that vertical distance, where if I measure the distance from the current price to the bottom UFO, then it would be that other distance, which, you know, it's very visual, it's very clear, it's very imbalanced. Okay, we are way closer than the top than what we are to the bottom. Okay, so can you do it? Yes, you could. You could certainly do it, because, you know, price is likely going to remain between the dotted lines. So you could certainly do that. But at the same time, it's a situation where the calls you would use above 104 are going to pay you way more than the puts you're going to sell below. Basically, the puts are probably going to be not providing anything at all, because they're so far away, they will pay extremely little. Okay, how much the 85 puts pay? Let's take a look out of curiosity. Well, they pay you 30 cents in theory, which you could say, oh, that's good enough. But the reality is that when you look at this, okay, look at this spread. What does that spread is telling you? No one is trading those 85s. Okay, and you can see that by looking at the volume today as well as the volume of the prior day. There's been no trading of the 85. Why? Because no one believes price is going to get there, because let's face it, it's not likely to go there. We already calculated that, you know, even below 93 is not even probable. So certainly reaching 85 is really, really far away from what probabilities suggest, isn't it? So what can I do to make this better? Well, I would like to find a better payment for the 85, first of all. And also I would like to find better liquidity, okay? So with the September 4, I don't get too much payment and bad liquidity. If I look at September 11, so I'm still getting very bad liquidity with 0 contracts, okay? 0.05 to 0.665. So 11 of September is not looking too good either. 18 of September, that's a monthly expiration. That may be better. It is better, okay? It is indeed better. A few contracts, 14 contracts yesterday. It's not a lot, but it's better, okay? But the problem is that I'm only being paid 22 cents, okay? Which we have a rule where normally we're shooting for at least 35. So again, September 18 is not good enough. September 25 is now paying me 52, but again, no liquidity at all. Okay, no liquidity at all. Look at the spread, 20 to 85. So based on what I'm seeing, probably I'm gonna have to go all the way to October 16, okay, which is the next monthly expiration date, to get something a bit more decent with liquidity. Okay, so let's take a look. October 2nd, 45.75. It's a bit better, okay, but it's still not so good. Okay, still not so good. Very huge lack of liquidity. What about October 9? October 9 doesn't even have the 85, so forget about this one. And the one I expect that, if it's going to be one, it's going to be this one. It's the monthly, as I was saying before. So let's see what's going to happen. So yes, this one is better, 85 to 105. And then we got, 40 to 60. So you can sell for 85, buy for 60, and you have a credit there. 11 contracts yesterday, for this one less, okay? But at least there is a little bit of open interest. So again, it's not amazing, but if it's gonna be one, it's that one, okay? So now, this is 50 days from now, okay? 50 days from now. Now we said earnings are on November 3, so we could certainly do a 16-day iron condor, it's not a problem. What did I say? 50 day, right? Yeah, 50 day iron condor. We can certainly do that, not a problem. Even though it's not ideal, we like to use shorter expiration dates. Okay, but why not? We can certainly give it a try. Now, in this process of giving it a try, the problem is that up to this point I was only focusing on the premium, but now we need to go back to focus on the probabilities. So if I load October 16, which is the monthly expiration, okay, the moment I click on that, watch these values on the top because they're going to change dramatically. So let's take a look. Okay. Well, first of all, strikes don't exist. Okay. So let's go ahead and restart. Move this down. So options, right click, analyze and sell, and run condor. Okay. And notice that now we are talking about 111 and 87. Okay. 111 and 87. So let's go ahead and take a look at that. So 87 is more or less here. Okay. And 111, it's more or less there. Okay, more or less there. So in other words, now it doesn't make a lot of sense to use that UFO. Okay. And then if I was to project the bottom distance, okay, this vertical purple bar, I was to project it to the top. So it looks like, using that particular UFO would make a lot of sense to end up more or less in the mid portion of this range. Okay, and therefore that would be a good starting point for this iron condor. Now this is a very wide range, but again, we need to survive 50 days, okay, for the trade to work. So let's see if this is going to be something that will work or it will not. Okay, now problem I see, okay, something that we don't like, okay, and probably or possibly is going to be the reason why this trade may not work, is the fact that the strike price increments that are given to us by the exchange for that stocks are $5 at a time. Okay, so what's the issue with that? Well, the issue with that is that you pick any of the options, for example, 65, and then you sell the 60 below. Next thing you know, you got $5 of risk. $5 of risk with options contracts, which represent 100 shares each. That's $500 of risk no matter what. So next thing you know, just out of the start, you start this trade with $500 of risk. So again, that is not ideal, okay, but that's what it is, okay, and that's it, and that's what it is. So this may end up giving us a little bit of trouble when we put the trade together, okay. So now when it comes to strikes, we have 110, we have 115. So let's take a look at what will be possible there when it comes to getting our premiums. So I'm just looking at the strikes. So again, we need to be using options above 111. Okay, we got 110 or 115. Okay, obviously we are closer to 110 than we were closer to 115. But then 85 is below these. Okay, and the next one would be 90. So it's a bit imbalanced. It's not super ideal. Okay, so I'm gonna start trying the 115. Okay, so basically I'm just gonna rely on that one better, right? So I'm gonna try the 115 and the 85, okay, and see how it goes. Okay, so let's try 115. Okay, which if I do 115 is gonna be 120 above. So 120, 115. Okay, and then we're gonna have 80 and 85. Okay, that's what we got. Okay, that's what we got. So and unfortunately, as I was expecting, it's not gonna work, guys. It's not gonna work. It's not gonna work. Okay, so let me tell you why very quickly, because there's no point of spending more time with this trade since it's not gonna work. So again, what is the risk of the trade? Is $5, right? So the difference between 80 and 85, that's what you're gonna lose. Okay, so now we are using a rule that says that as long as we collect 15% of that, then we're fine. Oh, you know what? I didn't look at this properly. It does work. I don't know how I did the math in my head. 15% of 5 is 75 cents. And guess what? 75 cents is what we will get. So, hey, let's spend a little bit more time here because it does look like we're going to be able to do this trade. Okay. Now, we're going to do something complex here. Okay. And it may work or it may not work, but we're going to do something complex. And I want you to pay close attention. So, what is the issue here? Okay, well, first of all, before I get into something more complex, let's make sure, what's the time? Okay, yes, we still have time to explain this properly. So take a look at this. So we have, we are buying the 120 call and selling the 115 call. This is above. We are using expiration is October 16, 2020, and earnings are November 3, 2020, and then below, okay, and then below we are selling the 85 puts, and below that we are buying the 80 put. Okay, this has a risk of $500, and we are collecting $75 per contract to do this trade. Okay, so again, based on that, it's valid. Okay, but I want you to realize that I'm leaning against that UFO. Okay, and let me ask you a question before I keep going, guys, because I could go. Sometimes I keep going forever. So let me pause here and check on you guys. And you guys, please tell me, how is it going so far? Is everybody following with the Iron Condor I'm putting together here on FISV? You guys, let me know. Ahmed, good to see you, my friend. Mark, very good to see you as well. Nice. So you guys give me a little bit of feedback. I'll take a sip of water if you don't mind. Thank you so much. Cool. So now, what's the issue? The issue is that I'm relying on that UFO, which has an ending point around 113, but the strike I'm selling is 115, which is more or less $2 above 113, right? Where on the bottom part, I'm relying on that UFO, which is 85.15, and I'm selling the 85, which is $0 away from the purple line. Okay, so in other words, my calls above are kind of like $2 higher, than compared to the puts below that are basically lining up perfectly with the purple line. And I cannot do anything about it because when I look at the option chain, okay, when I look at the option chain, I don't have the 113 strike or the 112. It doesn't exist. I go 110 or 115. But I could make it up. Okay, maybe I could make up one of those strikes. Okay, if I was to do the 110 and also do the 115 at the same time. Because if I do the 110 and the 115 at the same time, it's kind of like I'm using the 112.5, which doesn't exist. Okay, but if I do those two trades at the same time, okay, so it's kind of the same. So let me tell you what I'm going to try to do, because it's likely going to make this iron condor better, even though I'm going to double the risk. Okay, so the risk is going to be $1,000 instead of 500, but it's likely going to make this iron condor better. Not always, but many times, yes. So what I'm going to do is, okay, I'm going to go ahead and in parallel, okay, apart from buying the 120 call, okay, I am also going to buy another 120 call. So I'm going to buy two. And apart from selling the 115 call, I'm going to sell the 110 call. Okay, notice what I'm doing. I am duplicating my protective units, while when it comes to the options I sell one of the 115 and one of the 110, which will provide a similar effect as if I had sold the 112.5 that does not exist. Of course, on the bottom part, okay, I also need to do the same thing. So on the bottom part, to make it equal, because if not, it would be a totally imbalanced iron condor. So I'm gonna have to go ahead and sell the 85 put, sell the 85 put and sell the 85 put, and then I'm gonna have to buy the 80 put and buy the 80 put. So in other words, I'm gonna have to double, all of this. Okay, so let's do it. Okay, let's do it. So in order to do that, I'm just gonna insert, analyze, and sell another iron condor. Okay, I'm gonna bring my simulation up. And of course, I need to readjust all the strikes. So on the bottom part, I'm going to do 80-85, which is what I just wrote on the chart. And on the top part, instead of 120-115, I'm going to do 120-110. Okay. This, of course, is now giving us a much larger credit. Okay, much larger credit. But now, of course, your risk is way more, because now your risk here would be the distance between, wait a minute, I did pick 100, I should pick 110. Here we go. That's more reasonable. I was like, that would be, figure looks a bit too big. Anyway, so notice that now we have a risk of $1,000 here, okay, which we didn't have before. Okay, so if you look at the iron condor on the top, on the part on the left, okay, worst case, okay, if the market was to fall, we are risking 787.5. That's the worst case. But on the part in the right, worst case, we are risking 1,287.5. Okay. Notice that it's imbalanced in that sense because of the difference in the strikes. Okay. So one thing I could do is I could bring my 110, 120. Actually, I did it right. That's it. That's how it's gonna be. Okay, it would be slightly imbalanced. Okay, but again, take a look at this. So the most you can lose in this trade, and also let me make a point. The reason why it says here that the most you can lose is 1,290 is because this is what you would lose if you were to lose the whole $1,000 plus the whole $500, which is a total of $1,500, minus the premium collected, which is 75 and 135 is about $200. So 1,500 minus 200 plus, it's 1,290. So the graph on the top is telling you the real risk of the trade based on the premium collected. Okay, but in order to assess or accept, I should say, the trade or not, what we like to do is to look at the raw risk, which the raw risk would be to risk $10 on one of the condors and $5 on the other condor. That's 15. So we are risking 15, and if I'm going to be willing to accept 15% of 15 as the premium to be collected, that's 225, right? So the question is, if that's the premium I need, okay, how much is 0.72 and 132. Okay, well, 0.72 plus 132, that is 2.04. Well, actually, it doesn't meet our rule of 225. So actually, after all, I was pretty convinced it was going to work well. But after all, this added iron condor to try to balance out the fact that strike price increments are $5 at a time and trying to mimic or simulate a 112.5 strike, it's actually not working well. Probably because liquidity issues, maybe on the 110 or something like that. Yeah, yeah, I'm not sure. I would need to look at this more in detail. But anyway, it doesn't matter. It will not work. Okay, and therefore the only way to execute this trade will be the way we have it now. Of course, we need to shoot for 75. Okay, now it's providing 70. So if you were to place an order in the system, make sure you go for 75. Okay, make sure you go for 75, which is the minimum. We saw 75 earlier, so with a little bit of patience, you put the order in, and hopefully you get filled during the day. Okay, so I'm just gonna place the order so you see how this is done. Remember, we are back to a trade with $500 of risk. So if that's too large for you, don't take the trade. If that's okay, then you could consider taking it. If that's your choice. Okay, so anyway, limit order 75. I'm gonna keep it as a day order. Okay, place order, yes. So that's it. Confirmation, yes. So the order is in, waiting to get filled here, received. Okay, so we have our iron condor waiting to get filled at 75 cents. Now it's a matter of patience, and hopefully we get filled throughout the day. Okay, keep in mind the $500 risk that this trade has. Mark following fine, very, very good, perfect. Okay, so guys, let me go ahead and do a little additional drawing on the chart just to fully confirm for the ones of you that are newer to options trading. This is obviously a bit intimidating at first, isn't it? Or the reality is that it's actually quite simple when you get used to it, but at first it's a bit intimidating. But let me remove the options that are not to be used in the end. And what I'm going to do is have two vertical lines. So one today, which is the day we are taking the trade, and one in October 16. Okay, I may need to add many more days for that. So I would like to add 500 bars to the right, and we're going to go all the way to October 16. Here we go. So in other words, we are this trade is a trade where the expectation would be for the price of that stock to remain in this pretty large range. Okay, so this is a longer duration trade with October 16 expiration. That's a 50-day iron condor. So I'm going to put it here to be reviewed. And I guess we'll talk a lot about this trade along the way. Okay, and also there is a reason why I'm entering a long-term iron condor, because that way in future sessions we'll be able to discuss certain things that you guys need to know when trading options. Okay, cool. So that's it. That's our trade number one for the day. So let's move into other possible trades. Okay, sip of water if that's okay. Okay, so what else do we have? CHWY. So we have 55% probabilities. Yeah, that stock is making all times high, so it's not going to be a valid candidate. WPM also making all times high. Okay, waiting for pending data because there are two red UFOs there, so that one may work. Yeah, 50%, two UFOs. So we may have a trade here. We may have a trade. So let's take a look. Let's take a look. Earnings, WPM. So the next earnings for that stock will happen in November. Okay, so similar situation as FISV. We have no restrictions basically with expiration dates in this trade. We have lots of freedom there. Okay, so that's good. 50% are the UFOs in the regular session with pre and post market. We have 43%. That is not good enough, but 50% it's certainly very good. So we're gonna go for it. and we'll start with the option chain. We look at September 4 and see what's available. Liquidity is not super amazing, but it's not bad. So I'm going to right click, analyze and sell an iron condor, switch my 5% to plus 1 standard deviation, switch the minus to minus 1 standard deviation. And now we know that from now until September 4, same thing we did before. So we can see that that stock has potential to move between 47 something to 55 something. Okay. So 45, 57. So let's go ahead and get a dotted line. Oh, that's not going to work. Yeah, that's not going to work because 57 is actually beyond, okay, that UFO. So therefore, we're dealing with a very volatile stock, and there's no way we're going to be able to do a trade here. Okay, cool. Okay, so we are done with the non-directional trades. Okay, and therefore I would like to move into the world of credit trades. Okay, so credit trades is basically the same thing as the iron condors. The only difference, though, is that you are very directional on the non-directional approach. That's why we call it neutral. Okay, so basically, you don't care if the stock is going to move too far in a specific direction, but you do care the stock moving in the opposite direction. Okay, because having the stock move against you could be problematic after a while. Having the stock stay in the same place would pay you just as much as if the stock was to move all the way. So we are neutral long or neutral short, and the first list I loaded is the list with neutral long. Okay, Shopify, certainly a beautiful stock there. Also very nice options at times. Bit pricey, so I'm not sure we're gonna be able to make it work. 50%. So let's take a look at what we have with Shopify. It also depends on the strike price increments. So earnings on Shopify are going to take place in November. Okay, so November is going to be the next time. So that is pretty good because we have a lot of freedom when it comes to the selection of the expiration dates. So what I'm going to do is to load Shopify. Okay, and we're going to be looking at, we'll start with September 4. Okay, and yeah, so here's the problem. Okay, so strike price increments, $5 at a time. So again, we are in a situation where the minimum risk we're gonna be taking is gonna be $500. Okay. What about? Give me 1 second here. So if I look at the monthly, at the money, $10 at a time. $10 at a time. So we got more liquidity, but because its time is further out, it's So if I need to minimize the risk, we'll use either September 4 or September 11 because we got strike price increments of $5 at a time. Okay, so I'll start with September 11, September 4. I'm analyzing and selling a vertical spread this time. Remember, this is neutral long now. This is not non-directional. So I'm going to do that. And this is telling you that minus 1 standard deviation is 980. Okay, so I wonder where is that in the chart. So we're going to draw a dotted line at 980, which is here. Okay, so we need at least 2 UFOs to defend ourselves. So in other words, it seems that doing credit spreads below those UFOs and 971 would be a valid choice. Okay, so 971 is going to be 970 because there is no 971. Okay, and when we go so low, maybe $10 at a time actually. Well, we do have, we are being killed on liquidity here, guys. Yeah, if we sell an option, if we do this in the 970, we get paid 585, and we buy an option against and we pay 530, we are left with 65 cents of credit. Okay, 65 cents of credit, 55 cents of credit for a risk of 500 is not going to work because we said we want 15% of 5, which is 75, and this is not 75, this is 65. Let me say that again, 55, which is far from 75. So I'll give it a quick look at the September 11 just in case. It's not looking good, guys. It's not looking good, but since I have it, I'll take a look at analysis, changing the date to September 11. that it's telling you 958. So 958 is here, and therefore the UFO to be used would be that one. So we'll be using 935. So 935 using September 11 expiration date. We can do 935 and 930, and again we got $5 of strike price increment. But if you get paid 7 and then you have to pay 665, so then you are left with a credit of 35 cents, okay, which is even worse than the prior case. So yeah, so no good, okay, no good in this particular case for a neutral trade on Shopify. Okay, so we'll move to Netflix, okay, and see what's possible with Netflix. So Netflix, well, it's pending data, so we need to wait. First impression is not good with that 42%, but we have to wait a little bit. Okay. Pending data. Come on, data. Okay, so we got 42%, no good. And if I look at pre and post market, 42 becomes 41, no good. So let's move to the next one, which is Adobe. So Adobe is giving us 33% or 45, no good. ZM or ZM, 47%, no good. What if I move to pre-post market? 47 becomes 47, so no good. Alibaba, 45, and regular session is 44. By the way, this is not a surprise that you see a lot of lack of institutional interest, in the sense that orders are placed. If you get filled, orders are happy. If you don't get filled, orders are canceled. Why is that? Well, because those stocks are very high, and those market players, they are really speculating hard. Yeah, so Spotify technology. Okay, so we got 55%. So this is something we can work with. And if we look at pre and post market, we have 38%. That is not good. But 55, it is indeed something we can work with. Okay, and we got more UFOs below. So let's take a look at spot. Okay, Spotify. So earnings are going to be happening on October 28th. So we have plenty of dates in front of us for us to do a credit spread. So let's go ahead and load the option chain. I have not traded options on Spotify, so I am curious to know the level of liquidity for that particular stock. We are talking about $2.5 strike price increment, and liquidity is not looking bad, actually. Okay, so let's go ahead and right click to analyze and sell a vertical spread. So using September 4 and changing this to plus and minus 1 standard deviation. So this is telling us that that stock should stay above 254. So let's draw 254 on the chart. 254 is somewhere there. Okay, and we need to use at least 2 UFOs to defend ourselves. Well, I guess it's pretty obvious that we will be using options located below 223. That's probably going to be 222.5 or 225. Even yeah, I would be okay with that. Now, of course, I don't think we're gonna get paid enough using September 4 for the 225 or the 222.5. Yeah, and you can see here again 10 and 60. That's 35 cents. If you do 35 and then you buy 25, you are left with 10 cents of credit, and the risk is $2.5. Okay. So again, when you're risking $2.5 and you want 15% at least, so that is 37 cents, but this trade would only pay 10 cents. Okay, what does that mean? It means that we are using an expiration date that way too close. Okay, so we're gonna move to, let's try September 18. Okay, September 18 problem. Yeah, problem because we got $10 strike price increment. So let's try September 11. 222. Yeah, same story. If you sell, get paid 72, and you buy and you pay 60, you are left with 12 cents. So not working. Okay, not working. So let's move into September 25. If we do, liquidity here is very bad. Yeah, liquidity here is very bad. This is not going to work. Yeah, this is not going to work. I'll try one more. Yeah, liquidity is very bad, $80 to $2. Okay, so you sell 140 and then you pay 178. You actually end up with a debit instead of a credit. Okay, you pay more than what you get paid. So yeah, certainly not a good idea. Lacking liquidity for Spotify in the shorter expiration dates, it was more or less okay. In the longer expiration date, it was very, very bad. So we're gonna pass on Spotify and go for the next one, which is Okta. So we did an Iron Condor here some time ago, so we just review it today at the beginning, isn't it? So let's remove all those lines. This is a market now that it's allowing us to do a credit spread, but not an Iron Condor. So let's take a look at earnings for Okta. Earnings for Okta took place on, will take place on September 5. Okay, September 5. And that allow us to use September 4. We can use September 4, isn't it? So let's take a look at September 4 for Okta. Mark, need to change the horizontal line when you change the expiration date? Need to change the horizontal line when you change the expiration date. I'm not sure what you're talking about, Mark. I'll pay attention, but I'm not really sure where exactly. So let's analyze and sell a vertical spread. Oh, not a single. I wanted to do a vertical spread. Analyze and sell, vertical spread. And using September 4, it seems that stock would go as low as 199 or could go as low as 199. So let's go ahead and draw a line at 199, which is here. Okay, well, actually, I got a dotted line there, so that's going to be better. So 199 is somewhere here. Okay, and I guess it's quite obvious that when doing a credit spread on Okta, we would be using that strike, which is 195. Okay, so let's go ahead and take a look at the 195 and how much that pays. Okay, that would pay 61, and the next one 134. My friends, I believe we do have a trade here. So let's take a look. So if I do 195 and then I buy 192, okay, well, actually I don't. We don't. I don't know how I did the math. Okay, but we need at least 37.5 cents, right? Because the distance between strikes is $2.5. So 15% of 2.5 is 37 cents. And notice that we get 28. Okay, so that doesn't work. I'm not going to give up yet, even though it's quite unlikely it's going to work. But I want to take one last look. No. Yeah, it's not going to work. Yeah, no work. So we're going to pass on Okta. The 1 standard deviation line, that is the line you did not change. Yes, I did not change it because you're right, Mark, a very good observation, but I did not change it because since I said that I haven't traded options on Spotify, I was first very curious to see the level of liquidity as I moved further out in further out expiration dates. And since I got disappointed with the liquidity, then I never went back to the analysis tab. Okay, but you're right. This would have been my next step, which is to then reassess if probabilities were still okay with not reaching that strike. Okay, because if then, of course, by changing an expiration date to a much later expiration date, then you should also take this into consideration when it comes to the fact that price could move further away and more against you the more time you give it, right? So a very good point, Mark. I'm very happy you're paying very close attention to the session. Microsoft. So let's take a look at Microsoft. Okay, we got 49% on Microsoft. MSFT, earnings on Microsoft will take place on October 22nd. So we do have a collection of dates there that we can use. So let's go ahead and take a look. Let's load Microsoft. And this, my friends, is going to be the last trade I'm going to check. If we get a go, great. If we get a no-go, then it's good too. Okay, so I'm going to look at September 4. I'm going to right-click and analyze and sell a vertical spread. So what do we have? Minor one standard deviation is 212, 211 to 12. So I'm going to place a line at 212, which is more or less here. Okay, and obviously it seems that that UFO would be the UFO we'll be relying on. Okay, the UFO would be the UFO 211.51. Okay, so 211.51. Of course, Microsoft is super liquid. No need to check for that. But 211. Okay, we don't have 211. We have 212 or 210. Okay, so if I do the 210, okay, I'm gonna get paid 84. If I do the 215, I'm gonna pay 110. Okay, so let's try with both because both are more or less okay. 212.5 and 210. So 212.5 and 210. Okay, so 212.5 and 210. So if I do 212.5 and 210, I have $2.5 of risk, and therefore I need to collect 37 cents, but this trade is only paying 27, so it's not enough. If instead of 212.5, I move everything down and I go for 27.5 and 210, okay, so I still have $2.5 of risk, okay, but now I get paid 20 cents, which is worse. Okay, the prior case was better. So I got one last alternative, okay, before we either validate or invalidate the trade, which is what if I do 212.5 and 207.5, okay? Well, if we were to do that, now we have $500 of risk. It's $5 difference. So this times 0.15, remember, as we saw earlier, is 75 cents. And in this case, this trade would pay us 48 cents when looking at the midpoint, which is obviously less than 75. So in other words, no, we have a no-go with Microsoft. This trade is looking good from a technical and probability point of view, but is not looking good enough for us to take the trade. And by the way, it probably has to do with the fact that Microsoft going parabolic to the upside is getting everybody so calm that the prices of options are really crushing down, right? So you may want to wait for a little bit of a correction, get people scared, options inflate value. Sure it is, you may have to rely on that UFO now, and therefore you will be using the 210 instead of the 212.5, okay? But now the trade may work, okay? But not at this moment in time. So there is a little bit of waiting time, that needs to be in place. So in other words, we got FISV. That's the trade we got from today. Hopefully the session was enjoyable, my friends, and you guys have learned, or maybe I did get you all confused if you're new to options, okay? If that's the case, I'm joking, I'm serious at the same time. If that's the case, of course, options is a derivative asset, is more complex. So go ahead and make sure that you watch the videos in the sharpening playlist on the YouTube channel where we talk about options trading, and this will help you to understand options better because, as I always say, options give you options, right? So you better understand the options you got with options, okay? Anyway, everybody, you take care. Always my pleasure to join you and be here with you guys. See you in the next one. Be safe, be disciplined, and if you need anything, send us an email using the email address support@tradewithufos.com, and we will see you there. Take care, my friends. Bye bye, everyone.